Welcome back to the deep dive. Today we are opening up the hood on one of the great operational enigmas of the industrial world. We're talking about Illinois Tool Works, or as you'll hear us call it, ITW.
Right.
Now, this isn't just another Fortune 300 company. It's a massive, global, multi-industrial manufacturer that, often flies under the radar. But its business model is, frankly, a masterclass in strategic efficiency.
It really is a fascinating case study.
And our mission today for you is to solve this spectacular financial paradox that ITW has been living with for over a decade. Because on one side, you have this world-class, just truly elite financial performance. They've achieved record operating profitability, hitting an incredible 26.8% operating margin in 2024.
Which is just unheard of for a manufacturer.
Right, exactly. It's up structurally from 18.6% just 10 years ago. I mean, that is performance that rivals software companies, not heavy manufacturing.
Not at all.
But then, on the other side of the coin, during that exact same decade of margin triumph, their top-line revenue growth has been, well, largely stagnant, and recently even flat to negative.
Right.
Full year 2024 revenue actually saw a 1.3% decline. So here's the question we need to answer. How does a nearly $16 billion industrial powerhouse set new profitability records while, seemingly standing still in terms of sales?
And that tension you just described, that is the whole story of ITW. When you look at the source material, it's so clear that you cannot analyze this company using standard industrial metrics alone. It just doesn't work.
Because it's not a normal industrial company.
It's not a simple collection of factories. It's a highly refined proprietary operating system. And this system is designed to ruthlessly maximize profit and, maybe even more importantly, capital efficiency, even if that means deliberately shedding revenue or market share that isn't profitable enough.
So the flat revenue isn't an accident.
It's not a failure of execution. In many cases, it is the deliberate, intended side effect of an operational framework that views complexity as the absolute enemy of profit.
Oh, wow. Okay, so let's unpack this. Before we get into the mechanics of that model, we really need to appreciate the sheer scope of this enterprise. When we say industrial manufacturer, we are talking about a highly diversified global operation. They make everything from, say, the equipment that washes dishes in a five-star restaurant.
Right, the Hobart dishwasher.
Yeah, all the way to specialized components inside your next electric car.
Exactly. And that diversity isn't accidental at all, it's by design. The company did nearly $15.9 billion in revenue in 2024, and the key to its incredible resilience is that segmented structure.
The 7 segments.
The 7 market-leading segments. And critically, the largest one contributes no more than 20% of the total revenue.
So they're insulated.
Incredibly. It means they are protected when any single market segment, let's say global construction, hits a major downturn.
Okay, let's look at these segments, because the mix is, it's fascinating. The largest, which was a surprise to me, is automotive OEM, clocking in right around 20% of revenue. When I think of industrial giants, I usually picture like giant factory equipment, but ITW is a global supplier for the auto sector.
And that's a critical point.
Yeah.
They aren't just selling sheet metal or basic parts. They're making things like very specific braking components, specialized closure systems, and increasingly the really complex refueling and recharging systems that are necessary for modern hybrid and electric vehicles.
So they're selling the high value specified in parts.
Precisely.
Yeah.
This position in the auto supply chain is less about the ups and downs of car sales, the cyclical part, and more about the long-term trend, the secular trend, of cars just getting more technologically complex.
That makes a lot of sense. Okay, moving on. The second segment is one that I think really demonstrates the power of a good brand.
Oh, yeah.
Food equipment, sitting at about 17% of revenue.
This is where the brand moat truly shines. I mean, food equipment isn't about selling generic commercial appliances you'd find anywhere. They are selling the iconic, commercial-grade brands that professional chefs and huge institutions demand.
So we're talking about brands like Hobart.
We're talking Hobart for powerful warewashing solutions, Vulcan for those premium cooking ranges, Trowelson for heavy-duty refrigeration. These are not commodity producers.
And when you're running a restaurant, you can't have your dishwasher break down during dinner rush.
Never. Because they hold these dominant, trusted positions in the commercial kitchen, they can command premium pricing. And crucially, they are highly protected from margin erosion. And their parts and service businesses are just immensely sticky. Once you have a Hobart, you're probably buying Hobart parts for 20 years.
That reliability aspect in a professional setting, it just creates a really deep moat. Okay, we also have test and measurement and electronics coming in at a solid 18% of revenue.
Right, and that deals with the sophisticated equipment for things like electronics assembly and other general industrial applications.
And then we get to the segments that are really the profit engines.
This is where the numbers get, just incredible. The three leaders in margin, they each hover around 11 to 12% of total revenue, but they drive this outsized portion of the profit.
So like welding, for instance.
Welding is the perfect example. It generated 11% of the revenue, but it boasted a staggering 30.6% operating margin in 2024.
30% margin on welding equipment.
It's an almost unheard of margin in heavy equipment manufacturing.
And right next to it, there's specialty products, also about 11% of revenue.
And hitting a 30.3% margin. These are the segments where that customer-backed innovation model, which we're going to get into, has created products so differentiated that they've effectively eliminated any competition on price.
Oh.
Yeah. And then rounding out the portfolio are construction products at 12% and polymers and fluids at 11%. The whole structure just ensures that even if two of those segments are hitting a cyclical low, like construction is right now,
Right.
the other five are there to provide ballast, supported by those consistently high margins across the board.
So this diversification gives them resilience, but this is fundamentally a global operation, right? This isn't just about the U.S. industrial bank.
Oh, not at all. The global scale is non-negotiable for a company like ITW. They operate in 51 countries. And the sources show that over 53.5% of their total revenue in 2024 was generated outside the United States. They have to be able to capture demand wherever it surfaces, whether that's in emerging markets in Asia or, established ones in Europe.
And the revenue breakdown confirms that.
It does. North America is still the anchor at about 54%. But Europe, the Middle East, and Africa EMEA is a huge piece at almost 26%. And then Asia Pacific contributes another, nearly 19%.
But that much global exposure, I mean, that has to come with risks. Currency fluctuations alone must be a headache.
A massive one. And we see the real-world impact of that. The sources note they have a 30-cent per share headwind related to foreign currency translation baked directly into their 2025 earnings guidance.
30 cents a share just from currency swings.
That is not a trivial number. It's a constant battle for them.
So, okay, they are battling global economic softness, they're fighting FX headwinds, and yet they are still achieving record margins. Which brings us to the core mechanism, the proprietary framework that makes this whole divergence possible.
And what's so fascinating here is that ITW themselves, they view their business model, this proprietary framework, as their defining competitive advantage. It's practically a trade secret.
So it's not just something they do, it's who they are.
It is the absolute DNA of the company. And it operates as this sophisticated triad of interconnected elements.
And the first, and I think the most famous element, is the 80-20 front-to-back simplification process.
Right.
I mean, everyone in business school learns the basic Pareto principle, but ITW seems to have, weaponized it.
They've moved so far beyond simple categorization. They call it a front-to-back methodology. And that means it's applied across every single functional area.
So not just sales.
Not just sales. From how your salespeople are compensated, that's the front, all the way to how you allocate manufacturing floor space in the factory, the back. The sources confirm it's a proprietary step-by-step process used to manage complexity.
And the focus is what?
The focus is clinical. It is to identify and obsessively resource the 20% of products or customers that generate 80% of the profit. They call them their 80 customers. The goal is to maximize performance for that elite 20%.
And ignore the rest.
Not ignore, but to simultaneously minimize the costs, the complexity, and just the sheer distraction that comes with serving the remaining low-volume, low-profit 80%.
Okay, can you give us a concrete sort of step-by-step example of how this front-to-back application really works? Because for the listener, this is probably the most critical driver of their whole financial story.
Sure, let's imagine a division within their welding segment, a real-world scenario. So front-to-back might start on the front end, which is sales and R&D. They analyze their customer list and they realize, wow, 80% of our R&D spend and our best sales engineers' time is spread across 100 different types of small one-off customers.
Those squeaky wheels.
The squeaky wheels.
Mm-hmm.
But the top 15 customers are the ones buying all the high-margin specialty consumables and the advanced equipment. So the 80-20 mandate means they immediately reallocate 80% of their best people away from that low-profit customer base and put them solely onto those top 15 accounts.
So some customers are just going to get less attention.
Drastically less. Now for the back-end manufacturing and operations. They might discover that they have 300 unique stock-keeping units, or SKUs, in their product line, a huge catalog. But the 80/20 analysis reveals that 250 of those SKUs account for less than 5% of the profit. Yet they consume 40% of the storage space, they complicate ordering, they require specific raw materials.
A massive headache.
A massive, unprofitable headache. So the mandate then forces what they call product line simplification, or PLS. They accelerate the culling of those 250 slow-moving, low-profit items.
To stop selling them.
They stop selling them, even if it means losing those marginal sales.
And that culling, that deliberate shedding of revenue, that's what creates the flat top-line numbers we were talking about at the start.
Precisely. This is the great divergence in action. The sources specifically point out that in soft markets, this 80/20 mechanism mandates the PLS process. So when demand slows down, ITW doesn't chase volume by lowering prices.
No.
They double down on profitability. So if they report a negative organic growth number, like the minus 0.9% drag they quantified in the fourth quarter of 2024,
We should see that as a success.
you should see it as a sign that they executed the 80/20 discipline successfully. They eliminated complexity, and in doing so, drove their structural margin even higher. They are consciously trading revenue scale for profit quality and consistency.
That is a stunning level of discipline. But I have to ask, doesn't this risk alienating potential future large customers? I mean, aren't they risking their reputation or market share by deliberately telling the bottom 80% of their customers, sorry, we're not for you anymore?
That's the intellectual challenge of the model, right?
Yeah.
And it's a constant management balancing act. They mitigate that risk in a few ways. First, the 80/20 process ensures they're only shedding truly unprofitable complexity.
So it's not arbitrary.
Not at all. It's products or customers, where the cost to serve genuinely outweighs the margin they provide. Second, the entire process is designed to free up resources so they can absolutely overwhelm their remaining 80 customers with superior service and innovation. The goal has become so integral to the success of those top customers that those customers naturally grow their business with ITW, and the growth compensates for the revenue they lost from the bottom 80%.
Okay, that makes sense. And that brings us to the second element of the triad, which is critical for making sure that profitability machine also generates new business.
Yes.
Customer back innovation, or CBI.
This is the moat builder, and it's fundamentally different from the way most large industrials approach research and development.
How so?
Well, ITW explicitly avoids what they call the research center out model. You know, that classic system where a central R&D lab invents some new technology, and then the marketing team has to desperately run around trying to find someone who will actually buy it.
Right, a solution in search of a problem.
Exactly. Instead, their R&D, which was about $292 million in 2024, is highly decentralized, and it starts from the customer back. Division managers are trained to use that 80/20 filter to go find the biggest, most complex, most expensive problems that their top 80 customers are facing. And only then does ITW invest its R&D dollars to solve those specific high-value problems.
So they only invest in innovation where a profitable, high-value market already exists and is asking for a solution.
It is the very definition of capital efficiency.
I mean, it sounds so simple when you say it like that.
It's simple in concept, but incredibly hard to execute. But because they solve these bespoke, complex problems for premium customers, the solutions they create are typically highly differentiated, high performance, and crucially patented. This leads to that massive portfolio of intellectual property, currently around 20,900 patents granted and pending. And this IP is what prevents their products from being copied and becoming commoditized. It protects their pricing power and sustains those elite margins we talked about.
And finally, this whole thing has to be managed, which brings us to the third element, the decentralized entrepreneurial culture. I mean, how can a $16 billion global company possibly feel nimble?
The 80/20 framework is the answer to that, too. It's what enables radical decentralization without creating total chaos. ITW operates as roughly 80 distinct divisions. Now, if you just scattered those divisions across the globe with no unifying structure, you'd have an absolute mess.
Complete chaos.
But because every single division general manager is trained in the same 80/20 language and uses the same tools to determine what is important, who their 80 customer is, what products to cull, they can all operate with incredible autonomy. They are empowered to think and act like small business owners, making agile, local decisions rapidly, all while maintaining strict adherence to the overall global goal of maximizing capital return and margin.
So it keeps bureaucracy down.
Minimal. And nimbleness high.
Here's where it gets really, really interesting because the financial statements are basically the scoreboard for this unique strategy. And you just see this stark contrast between the stagnant top line revenue and the world class, constantly expanding profitability over the last decade.
Let's start with that top line because the revenue challenge is real. Full year 2024 revenue of $15.9 billion was a 1.3% decline from the year before. That's a fact.
And it's not getting better fast.
No. Looking at management's guidance for 2025, which anticipates 0 to 2% organic growth, it confirms that they are still operating in a very soft industrial economy. And that's compounded by their own internal 80-20 culling process. So revenue is cyclical and remains highly muted.
But the margin store, I mean, it's like it's from a different universe. We are talking about a relentless structural expansion that seems completely independent of the economic cycle.
It is truly remarkable. The operating margin went from 18.6% in 2014 to a full-year record of 26.8% in 2024. And watch the acceleration. Even in 2025, a year projected for flat revenue, they posted sequential record operating margins quarter after quarter, culminating in an all-time high of 27.4% in the third quarter of 2025.
So that's proof.
It's proof that the model is still executing, even against some very stiff cyclical headwinds.
That phrase, structural margin expansion, that's the key. We know it's not just external luck or a good economy.
Yeah.
How does management ensure this expansion happens year after year without, simply running out of complexity to cut?
That's the beauty of their operational process. Management is explicit about this. This margin growth is structural, driven by what they call enterprise initiatives.
Which is code for 80-20.
It's code for 80-20. These initiatives consistently add 100 to 140 basis points to the operating margin every single year.
So a full percentage point of margin improvement, guaranteed.
That's the goal. The reason they don't run out of things to cut is twofold. First, complexity is like a weed. It constantly creeps back into a business of this scale. Sales teams might add new, low-volume customers, or engineers might launch a niche product line to chase a small opportunity. The 80-20 mechanism isn't a one-time cleanup. It is an annual, mandatory filter applied to every single division.
So it's a constant process of pruning.
Constantly. And second, every acquisition ITW makes, and they've made many over the years, is immediately put through the 80-20 ringer. They force the acquired complexity out and immediately boost the profitability profile of the new asset. It's a perpetual machine of simplification.
And this level of operational rigor, it naturally translates into capital efficiency metrics that are just. They're elite.
Absolutely. The primary metric for economic quality and value creation for any company is return on invested capital, or ROIC. ITW hit a record 31.2% in 2024, and they're guiding for similar performance in 2025.
And what does that number really tell us?
It tells you that for every dollar they invest in their business, in factories, in R&D, they're generating over 31 cents in profit. Generating a return that is 3 or 4 times higher than your cost of capital signals an extremely high-quality business model that is constantly creating value.
Now, let's talk about that astronomical return on equity, or ROE. The sources show a 5-year average of 88.9%. I mean, that number looks like a typo in manufacturing.
It is incredibly high, and it demands a little bit of clarification for you, the listener. While ROE is a measure of profitability relative to shareholder equity, in ITW's case, that exceptionally high number is significantly amplified by the company's intentional use of leverage. By using debt. Think of it this way, using a household analogy. If you buy a house for $500,000, and you put down $100,000 of your own money, your equity, and then the house appreciates by 10%, a $50,000 gain. Your return on your equity is a massive 50%.
50,000 on my 100,000, right?
Right. If you paid all cash, your return would only be 10%. ITW uses manageable debt to finance its operations and, critically, its massive share buyback programs. Those buybacks reduce the equity base on their balance sheet. And a smaller denominator, the equity base, means the net income appears huge in relation to it. It mathematically boosts that ROE figure, proving they're optimizing their capital structure for maximum shareholder return.
And all that efficiency, all that optimization, it results in ITW being a prolific generator of real, tangible cash flow.
They are a classic cash flow machine, which is really the ultimate test of a capital-light, high-margin model. They consistently target 100% or more free cash flow conversion of net income.
So every dollar of accounting profit becomes a dollar of cash.
Or more. Full-year free cash flow in 2024 was $2.86 billion.
Oh, no.
And because their R&D is so efficient, only about 1.8% of revenue, and their capital expenditures are low because of all the simplification, they don't need to reinvest heavily into their existing lines. That just leaves this huge pile of cash available for distribution back to shareholders.
Okay, so if we connect all this back to the broader market, we have a company built for internal perfection, but it's battling an often imperfect, cyclical external environment. To really grasp ITW's niche, we need to analyze its competitive posture against its rivals.
Yes.
And the sources make this really clear distinction. ITW is the diversified giant, and it's always competing against focused specialists.
Yeah.
How does that strategic difference actually play out?
Let's use the segments we already discussed. Take food equipment. ITW's moat, driven by 80/20, is all about highly stable, premium-priced product quality anchored by those brands like Hobart. They compete against companies like Middleby. Now, Middleby often grows by aggressively acquiring niche brands and then focuses on system integration.
What does that mean?
It means they try to win contracts to supply the entire integrated suite of kitchen equipment for a large chain like a Starbucks or McDonald's.
So ITW sells the best dishwasher, Middleby tries to sell the whole kitchen.
Exactly. So ITW achieves margin excellence and capital return. Middleby focuses on capturing revenue breadth and system control, often accepting lower overall margins to get the whole contract. Now, consider test and measurement and electronics. ITW is diversified here, providing general high-quality industrial applications. They compete directly with a company like Nordson. Nordson is the definition of a precision specialist. Nordson's entire business model is built around achieving absolute technological supremacy in a single high-stakes application, like nanoliter-level fluid dispensing for complex electronics assembly. They do one thing better than anyone in the world.
So the insight here is that ITW's disciplined, diversified structure gives it best-in-class margin stability, that 27% margin through all cycles. But it makes it structurally harder for them to match the high organic growth rates that can be achieved by these laser-focused specialists who can just dominate a single fast-growing niche.
Precisely. ITW chooses consistency and compounding quality over raw speed. The specialist might hit 15% growth in a good year, but ITW maintains its 27% margin regardless of what the economy is doing. So the question for you as the investor is whether you prioritize the growth speed of the specialist or the operational stability of the giant.
Fortunately, even a diversified giant benefits from these long-term structural tailwinds that are providing some essential lift right now, especially since their organic growth is only around 1%.
We can identify three key secular tailwinds. The first, and currently the most impactful, is electrification. ITW's automotive OEM segment has been a secular winner. Just look at the Q3 2025 results. While the total company growth was only 1%, the auto OEM segment was leading the pack at a robust plus 5% organic growth.
And why is that?
The core reason is that the shift to EVs and high-tech hybrids requires more complex and more expensive non-powertrain components. ITW's expertise lies in thermal management systems, specialized fasteners for battery assembly, and those sophisticated refueling and recharging systems. They are selling engineered complexity, which is exactly what their customer-backed innovation model excels at creating.
Okay, the second major trend. This one ties directly to global instability and supply chains.
That's the trend towards supply chain resilience and reshoring. Post-pandemic, the vulnerability of these extended global supply chains has driven a major long-term trend of nearshoring or reshoring manufacturing back to regions like North America.
So companies are building factories closer to home.
Exactly. And when companies build new factories or expand existing ones domestically, they drive immediate demand for new equipment and materials. This directly benefits ITW's construction products, their welding segment, and their polymers and fluid segments. It provides demand that is structural and not just reliant on the immediate consumer cycle.
And finally, a factor tied to demographics and technology, automation.
Automation and Industry 4.0. The persistent structural shortage of skilled labor across virtually every industrialized economy is forcing manufacturers to invest heavily in smart factories and automated industrial processes. And ITW's components and systems are often embedded deep inside those automated solutions. This is a persistent tailwind that will likely continue for the next decade until the labor market normalizes, if it ever does.
Okay, but despite those great long-term trends, we saw the immediate weakness in Q3 2025, where total organic growth was only plus 1%. So the resilience in the auto OEM segment must be acting like a shield, masking some really serious cyclical pain in the other segments.
It is a perfect illustration of the great divergence in action. While auto OEM was up 5%, the segments most exposed to the slowing industrial capital expenditure cycle were hurting.
Like construction.
Construction products saw organic growth decline by 2.3%, and polymers and fluids was down 3.1%. These figures just reflect the reality that large construction projects and industrial maintenance spending are being delayed globally. So ITW is fighting a strong cyclical headwind, but the internal 80-20 mechanism and that secular auto strength are absorbing the blow, allowing them to still post record-high margins in the middle of a slowdown.
That structural resilience gives them the luxury to look forward. I mean, the last decade was clearly dominated by this margin architect strategy. But now the company has announced a fundamental strategic pivot. They're calling it the Next Phase strategy, launched in 2024 with ambitious goals stretching all the way to 2030.
This is where the story gets incredibly compelling for the future, for any learner or investor. For the 12 years leading up to 2024, the focus was singular: ruthlessly maximize margin. And E. Scott Santi, the retiring CEO, he successfully executed that, more than tripling earnings per share. It was a huge success.
But there's a new chapter.
A completely new chapter. The new phase, marked by the orderly 2024 transition to Christopher O'Herlihy, a longtime company veteran, comes with a completely new, explicit mandate. The goal is no longer just margin expansion. It is to make organic growth a core ITW strength, achieving growth rates on par with their current elite financial performance.
So they're trying to solve the problem that their own success, the 80-20 culling, created, the flat growth problem.
They are. They are essentially trying to become the fastest, highest margin, diversified industrial company in the world. It's an enormous undertaking.
How is management? How are they quantifying this pivot? What's the new scorecard we should be looking at to track if they are really shifting from being a margin engineer to a growth engineer?
The most critical piece of data for you, the listener, to track from here on out is the new metric they introduced specifically for this strategy. It's called the Customer Back Innovation Yield, or the CBI yields.
Pretty valuable.
This metric measures the percentage of total organic growth that is derived only from their patented, differentiated products created via that CBI process we talked about. It isolates the high-quality, sustainable internal growth they're aiming for. So in 2024, that CBI yield was 2.0%.
2%.
The strategic goal for 2030 is to hit a sustainable yield of 3% or more. This 100 basis point increase in internal structural growth is the entire foundation of the next phase thesis.
Let's discuss the profound significance of that. Moving the yield from 2% to 3% doesn't sound like a lot, but what does it really signal?
It's everything. The current 2% yield is critical because, as we noted, it is currently being offset by the general cyclical drag and the intentional 80-20 product culling. So if the company is growing its innovative products at 2%, but the cyclical downturns are pulling the rest of the business down by 1 or 2%.
The net result is flat growth, 0 to 2%.
Yeah, exactly. The bull thesis, the argument for why ITW deserves a growth premium on its valuation, requires that 2 to 3% yield to become additive to a market recovery. When the industrial economy eventually recovers, the market itself will naturally provide, say, 2 to 3% growth. If ITW has managed to build its CBI yield to 3% by then, their total organic growth could be hitting 5 to 6% sustainably.
And that's the acceleration the market isn't pricing in yet.
That is the necessary acceleration that would justify the valuation premium.
So how does management credibly raise this yield? I mean, it's one thing to put it on a PowerPoint slide. It's another thing to execute it across 80 decentralized divisions.
They are focusing the entire 80-20 mechanism on this goal. They're taking the resources that were freed up by culling the bottom 80% and aggressively redeploying them into faster commercialization of new CBI products and solutions for their top customers. It means speeding up the process from a patent application to market adoption. It means ensuring that those 80 divisional managers prioritize the development of entirely new complex solutions rather than just optimizing existing product lines.
It's a real cultural shift.
A huge cultural shift from efficiency maintenance to growth acceleration, all within that same restrictive 80-20 framework.
So this raises an important question for me. We've established that ITW is a highly capital-light business. It throws off nearly $3 billion in annual free cash flow. How does a company with such high internal efficiency deploy that massive cash pile?
The answer is their highly disciplined capital allocation framework, which places shareholder returns at the absolute top of the priority list.
Not reinvesting in the business.
Well, that is the defining trait of this mature cash cow. The internal reinvestment is highly targeted and, frankly, modest. We noted R&D is only about 1.8% of revenue. The striking statistic that defines ITW's prioritization is the sheer ratio of cash returned to shareholders versus cash invested internally.
What's the ratio?
In 2024, they returned $3.2 billion to shareholders through dividends and buybacks. Now compare that to their estimated internal reinvestment CapEx plus R&D of only $600 to $700 million.
Wow.
We are talking about a 5-to-1 ratio of returns to reinvestment. ITW's primary value lever for the past decade has been the incredible efficiency with which it returns cash to its owners.
And that emphasis on cash return is reflected in their prestigious Dividend King status, which is a massive appeal for long-term, income-focused investors.
It's an almost unparalleled track record in the industrial space. ITW has increased its dividend for 61 consecutive years.
61.
They paid $1.7 billion in dividends in 2024, and they recently announced a healthy 7% dividend increase for 2025. This means that ITW provides one of the safest, most reliably growing income streams available on the public markets.
And the dividend is complemented by a consistent, aggressive share repurchase program.
The buyback program is a core element of their capital management strategy, particularly as it relates to that boosted ROE figure we discussed earlier. They executed a substantial $1.5 billion in share repurchases in 2024 and have planned another $1.5 billion program for 2025.
And that's just a way to boost the stock price.
It's a way to boost earnings per share. This consistent reduction in the overall share count is significant. It ensures that any stock issued to management as compensation is more than offset, which continually reduces the total shares outstanding and provides a reliable boost to EPS, helping to compound shareholder value through the cycle.
Okay, so as we synthesize all this information, we really have to review the balance of risk and reward here. ITW is obviously a high-quality name, but attempting a major structural pivot like this carries inherent risk.
The absolute primary risk is the execution risk of this next phase strategy. It's that simple. The market has already awarded them a premium valuation for perfecting the margin expansion machine. If the new CEO and his team fail to accelerate the CBI yield past that 2% baseline, if organic growth remains stuck in that low 0 to 2% range, the entire investment thesis for future appreciation is threatened. They have to prove that the culture can shift from cutting to growing.
And of course, the general cyclicality remains a factor.
Always.
ITW is still highly leveraged to industrial production. We noted that about a third of their revenue, 32%, is tied to the highly cyclical automotive and construction sectors. So while their structure buffers them, a severe global recession would still cause material earnings pressure. No one is immune to that.
No, and we have to reiterate the geopolitical risk. Operating globally means over half of their revenue is exposed to currency fluctuations. That real-world FX headwind of 30 cents per share that's baked into the 2025 guidance is a constant reminder that macro forces can erode otherwise stellar operating performance. They have to continuously manage trade policy, tariffs, and geopolitical instability in major regions like China and Europe.
Let's talk about the price tag for all this quality. If you, the listener, buy ITW today, what does the valuation tell you about market expectations?
ITW is currently trading at a trailing PE of about 23.7.
Okay.
The context here is critical. This valuation is almost exactly in line with its 10-year historical average PE of 23.6.
That is fascinating. It sounds like the market is giving them zero credit for the future growth pivot.
That is the precise interpretation. The market is in a definitive wait-and-see mode. It is fully pricing in the quality, the incredible ROIC, the 27% margin, the stability, the Dividend King status. The current PE is a quality multiple, but it is not yet pricing in the growth acceleration that the next phase strategy promises. You're essentially paying the fair historical price for the margin machine, betting zero on the growth acceleration.
So what's the catalyst?
The major catalyst for expansion of that multiple for moving the PE from 23 up to perhaps 28 would be tangible, sustained proof that the CBI yield hits 3% or more and that the company can post organic growth in the 4 to 6% range. Conversely, the catalyst for contraction would be if organic growth remains stubbornly flat in that 0 to 2% range when the industrial economy recovers. That would force the market to re-rate them back to a lower, no-growth industrial multiple.
So given this risk-reward profile, what kind of investor is ITW best suited for right now?
ITW is the stock for the informed learner who prioritizes consistency, safety, and shareholder-friendly practices above all else. It is a quintessential buy and hold core position for compounding capital and income through the economic cycle.
It's not a get-rich-quick stock.
Not at all.
Yeah.
If you are looking for dramatic high growth or a deep value turnaround, this isn't it. This is for the investor who values predictable, structural earnings power above all else.
And finally, based on everything we've read and discussed, what is the single most important metric for you, the listener, to track in ITW's future earnings reports?
It is definitively the customer-backed innovation yield.
Not just revenue.
Forget the total organic growth number for a moment. That's contaminated by cyclicality and culling. The old scorecard was the operating margin percentage. The new scorecard is the CBI yield percentage. If ITW reports 3% or more in future quarters, it signals that the structural growth engine has successfully been integrated into the 80/20 machine, and the future valuation is likely justified. If it stays at 2% or worse, drifts lower, the growth pivot has failed, regardless of what the overall economy is doing. The ITW story is, it's just a unique masterclass. It's a diversified industrial giant that perfected the art of creating complexity internally through its proprietary 80/20 model to achieve this profound simplicity and high-value differentiation for its best customers. That historical success, driven by the margin architect culture, is undeniable. It's given them world-class profitability and returns. But the success of the next phase, the strategic shift to becoming a growth engineer by emphasizing that CBI yield, that is the ultimate test of whether a highly efficient machine can successfully learn to innovate and grow at speed.
So what does this all mean? The ITW business model is defined by its ability to execute two, really, opposing strategies at the same time. Ruthless simplification, the 80/20 culling of the unprofitable 80%, and high-value differentiation, the CBI serving the top 20%. The ultimate question for you, the learner, as you track that CBI yield is this. Can a giant manufacturer that perfected the art of eliminating the least profitable 80% of its business successfully pivot its entire culture to focusing solely on adding high-growth, profitable revenue? Or is the 80/20 model, the very thing that built their margin success, inherently self-limiting to low organic growth forever? That's a challenging thought to compound on. Thank you for joining us for this deep dive into Illinois Toolworks. We'll catch you next time.